For today's market briefing, we are going to analyze a significant divergence we're seeing in the market, the gap between a company's stock price and its underlying intrinsic value. Our focus will be on two specific names, Amazon and PayPal, where we will present a data-driven thesis for why a potential mispricing exists. So what's happening on a macro level? We are observing a rotation of institutional capital. Smart money appears to be moving out of momentum-driven assets and into high-quality, profitable platform companies that are trading at a discount. This is the divergence we are here to analyze. Here is our agenda. We'll begin with Amazon and its often overlooked profit centers. Then, we will shift to PayPal to examine the valuation disparity in that name. From there, we'll discuss a disciplined strategy for execution. And finally, we'll conclude with our primary takeaway. Let's begin with Amazon. The market seems to be making a fundamental error in its assessment, viewing the company primarily as a low-margin retailer. But that perspective completely misses the most critical components of the business. Now, let's look at the data. Amazon's forward price-to-earnings ratio currently stands at about 28. In isolation, that number might not seem unusual. But when you compare it to its 5-year historical average of 60, you see a major disconnect. This isn't a minor fluctuation. It's a substantial deviation that signals a potential mispricing by the market. So the obvious question becomes, what exactly is the market overlooking? The answer isn't found in their e-commerce sales figures. It's found in a segment of the business that functions as a high-margin profit engine. Consider this number, $55 billion. That is the current annual run rate for Amazon's advertising business. To put that in perspective, this division is growing at a faster pace than its counterparts at both Google and Meta. This is not a secondary business line. It's a core driver of profitability. And here's the critical point. While retail operates on very thin margins, advertising revenue is almost entirely profit. This massive stream of high-margin cash flow is what subsidizes the retail operation and, crucially, funds the company's strategic, capital-intensive investments into AI and cloud infrastructure. Now, if we apply a sum-of-the-parts valuation model where we value each business segment as a standalone entity, the disconnect becomes even clearer. AWS, advertising, and retail, valued independently, would have a combined intrinsic value of roughly $2.2 trillion. That figure is substantially higher than the company's current total market capitalization. All right, let's pivot to our second case study, PayPal. This is a clear example of a flawed market narrative driving down the valuation of a market leader. There is a prevailing story about PayPal that simply is not supported by the underlying business fundamentals. The common narrative is that competition, particularly from Apple Pay, is eroding PayPal's business. But the data tells a very different story. PayPal's total payment volume, the amount of money processed on its platform, continues to grow at a consistent rate of 6 to 8% year over year. As a result of this negative narrative, the stock's valuation has been compressed. It's currently trading at a forward PE of approximately 14. That's not only cheaper than the S&P 500 average, but it's less than half the multiple of its direct competitor Block. The market is valuing it like a legacy financial institution, not a core fintech player. And despite this depressed valuation, the company itself remains a powerful free cash flow generator. We're looking at over $6 billion in annual free cash flow. That capital provides significant flexibility to drive shareholder returns. So how is that cash being deployed? Primarily through aggressive share repurchases. Over the last 12 months, the company has reduced its total share count by nearly 8%. This is a critical point as it provides a mathematical tailwind to earnings per share, even with zero net income growth. Okay, so we've established the why behind this thesis. Now let's address the how. Given the current market volatility, a disciplined approach to entering any position is paramount. A methodical strategy to consider is the 3-tranche method for building a position. The first tranche, 1/3 of the total allocation, establishes an initial position at current levels. The second third is deployed via limit orders at key technical support levels to capitalize on potential pullbacks. The final third is held in reserve, providing dry powder in the event of a significant macro-driven market decline. This approach is designed to manage risk and improve the average cost basis. To conclude, this thesis is not about chasing momentum or short-term trends. It's about identifying opportunities to invest in the fundamental infrastructure of the modern digital economy. So, to summarize the core points, the market appears to be mispricing these high-quality platform companies. For Amazon,
The true value lies within its high-margin advertising and AWS divisions, not its retail arm. For PayPal, the current valuation is based on a false narrative that ignores its persistent growth and strong cash flow generation. The opportunity, therefore, is to acquire core digital infrastructure at what appears to be a historical discount.
I will leave you with a final question to consider. Is the market currently so focused on short-term narratives and headline risk that it is overlooking demonstrable fundamental value? Based on the data we have reviewed today, the conclusion is difficult to ignore.